Welcome to the Trendline Gala podcast. Today, we are walking through something really foundational, I think, for anyone who's ever traded or even just curious about how markets actually work.
Right.
Because for most people just starting out, the idea of risk seems so simple. You buy something, and the risk is that the price goes down.
That's it. That's the basic idea everyone starts with and makes perfect sense. You're trying to guess the direction.
But today, we want to look a little closer at a whole other set of risks. Risks that are there even when you guess the direction correctly.
And that's the part that can be so confusing for beginners. The idea that you can be right, but still not make money. Or even lose money.
Exactly. You could do all your homework, predict a stock is going to go up, and it does. It goes up just like you thought, and then you check your account, and the profit is, well, it's way smaller than you expected.
Or it's gone. That gap, that disconnect happens because the system itself has friction. It's not a perfectly smooth machine. There are all these little costs and delays built in.
So our mission today is pretty simple. We're going to break all this down. We'll use some everyday examples to show that these risks aren't about being reckless. They're just part of how trading works.
Let's start with the most obvious one, the cost of just getting in and out of a trade.
Let's do it. So right off the bat, the moment you decide to trade, there are hurdles. We're talking about things like fees, commissions, and something called the spread.
Yeah, and they can feel really small, almost invisible, on one trade. But if you trade often, they add up. It's like a constant headwind blowing against you.
So let's start with commissions. Here's what we know.
Hmm.
A commission is basically a service fee. Your broker handles the trade for you, and you pay them for that service.
And we have to remember, this used to be a huge deal. I mean, decades ago, a commission to buy stock could be hundreds of dollars. It really kept small investors out of the market.
Wow. So things have changed a lot.
Oh, massively. Today, you see commission-free trading everywhere, especially for U.S. stocks. The competition between online brokers drove those fees way down.
But commission-free doesn't actually mean cost-free, does it?
That's the key thing to understand. It just means the broker is making money in a different way, a less obvious way.
Okay, so how does that work?
Well, often through something called payment for order flow, PFOF. When you place a trade, your commission-free broker might sell your order to a big high-speed trading firm.
They sell my order.
Yeah. That firm then executes your trade, and they might fill it at a price that's, say, a fraction of a penny worse for you than the absolute best price available at that microsecond.
And they keep that tiny difference.
To keep that fraction of a penny. And when you multiply that by millions and millions of trades every day, well, it adds up to a lot of money. So you didn't pay a commission, but there was still a cost. It was just hidden in the price you got.
That is the ultimate hidden cost. Let's use a more old school example to make it really clear, though. The one about Susan's trade. It shows how even visible commissions can really eat into profits.
Okay, so Susan thinks a company, let's call it Conglomo Corp, is a good buy. She buys 100 shares at $10 each.
So that's $1,000. Nice and simple.
Right, but her broker charges a 2.5% commission to buy.
Okay, so 2.5% of $1,000 is $25. So her total cost to get in is actually $1,025. She's already in the hole.
Exactly. Now, fast forward 6 months, she was right. The stock went up 10%. Her shares are now worth $1,100.
So on paper, that's a $100 profit.
A $100 gross profit, yes. But now she has to sell. And her broker charges a 2% commission to sell.
2% of the new value, $1,100. So that's $22.
So let's do the math. She paid $25 to get in and $22 to get out. That's $47 in total fees.
And her profit from the market was $100. So you take away that $47,
Right.
her real take-home profit is only $53.
The commissions ate almost half her profit. She was 100% right about the direction, but the cost of doing business cut her winnings nearly in half.
And that was a trade she held for 6 months. Imagine if she was trying to do that several times a day.
It would be impossible. The costs would just grind the account down to zero. It shows how the cost structure itself can make a strategy completely unworkable.
Okay, so that's the explicit fee. But there's another cost, one that's always there, the spread.
The bid-ask spread. This one is so important, and it surprises a lot of people. You think there's one price for a stock, but there are actually two.
Always two prices.
Always. There's the price someone is willing to buy at. That's the bid. And there's the price someone is willing to sell at. That's the ask. The ask is always a little bit higher.
And the difference between those two is the spread.
That's the spread. The simplest analogy is a currency exchange booth at the airport. They'll buy dollars from you at one price and sell dollars to you at a higher price. The difference is how they make their money.
So when I go to buy a stock, I have to pay the higher price, the ask price.
You do. And here's why that matters so much. The moment your trade goes through, you've bought at the high price. But the market's sell price is still the low price. So you immediately start with a small paper loss.
So I'm underwater from the very first second.
Yes. The price has to move up just enough to cover that spread before you can even get back to zero, before you can make a single penny.
It's like starting a race a few feet behind the starting line.
Perfect analogy. And the size of that spread tells you a lot about the market for that stock.
What do you mean?
Well, if the spread is really small, maybe just a penny or two, it means there are tons of buyers and sellers. It's a busy, active market. We call that high liquidity.
Like for a really big, popular company?
Exactly. But if you see a stock where the buy price is, say, $10 and the sell price is $10.50, that's a huge 50-cent spread.
What does that tell you?
It tells you not many people are trading it. It's a quiet, shallow market, low liquidity. And it means your cost to trade is much, much higher. You have to make up that whole 50 cents just to break even.
And that's before any commissions.
Before anything else. It's a built-in cost for just participating.
So we've covered the costs you pay just to get in the game. But what about the risks that happen when things are moving really fast? Let's talk about execution problems, starting with slippage.
Right. So if costs are the toll you pay to get on the highway, slippage is what happens when traffic is moving at 100 miles an hour.
Okay, what is it exactly?
Slippage is just the difference between the price you expected to get and the price you actually got.
I think the best way to explain this is buying something online. You see a concert ticket for $50. You rush to put in your payment info. You click buy.
And the little wheel spins for a second.
And then the confirmation comes through and you were charged $52. Because in that split second, the price changed. That extra $2 is slippage.
It's the exact same thing in trading, but it happens in microseconds. And it happens because of high-frequency trading programs, HFTs. These are supercomputers that can see and react to price changes faster than a human ever could.
So when I click buy on my laptop, my order has to travel over the internet to my broker and then to the exchange.
And in the tiny fraction of a second that takes, those algorithms have already seen the demand and nudged the price up. So by the time your order arrives, the price you saw on your screen is already gone. You pay a little bit more.
That sounds a little unfair.
It's just the reality of the modern market structure. It's a game of speed. And that's why this is a structural risk. It's part of the system.
Let's use the stock example. Let's say I want to buy at $183.53. I see it on my screen. I hit the button.
But the market is moving fast. Your order gets filled at $183.57. That's 4 cents of negative slippage.
4 cents. Doesn't sound like a lot.
On one share, no.
Yeah.
But if you're buying 100 shares, that's an extra $4 you didn't plan on spending. If you're buying 1,000 shares, it's $40. It adds up.
And I imagine this happens most when the market is really chaotic, like after big news.
Exactly. When volatility is high, slippage is much more common. And that's often the exact moment you're trying to get in or out quickly.
Now, can slippage ever be good? Can you get a better price?
You can, yeah. That's called positive slippage. The price could move in your favor while your order is traveling. It's possible. But, the system is generally designed in a way that makes negative slippage for retail traders a bit more common.
Okay, so is there any way to protect yourself from this?
There is. The main tool is called a limit order.
A limit order? How does that work?
With a normal market order, you're telling your broker, get me in now, I don't care about the exact price. With a limit order, you're saying, I want to buy, but I refuse to pay more than this specific price.
So if I set a limit order to buy at $50, I will never pay $50.01.
Correct. If the price jumps above 50 before your order is filled, the order just go. It doesn't happen. It waits.
That sounds like a perfect solution. Why doesn't everyone just use limit orders all the time?
Because there's always a trade-off. The big risk with a limit order is that you miss the trade completely.
Oh.
The stock might drop to $50.01 and then shoot up to $60. You were right about the direction, but because you insisted on your exact price, your order never got filled. You were left at the station while the train left.
But it's a choice between getting the price you want or guaranteeing you get into the trade at all.
Exactly. Price certainty versus execution certainty. It's a strategic decision you have to make for every single trade.
This episode is sponsored by TrendlineGala.com. Quiz your way to financial mastery.
Okay, so we've talked about friction inside the trading day, but what about what happens when the markets are closed? The risk doesn't just stop overnight.
Not at all. In fact, some of the biggest risks happen when you can't do anything about it. This brings us to gap risk.
A gap, what does that mean?
It means the market closes at one price on, say, Tuesday afternoon, and then opens at a completely different price on Wednesday morning. It doesn't trade smoothly through all the prices in between. It just jumps or gaps. And on a chart, it looks like a literal empty space.
It does. And these gaps are almost always caused by big, unexpected news that comes out overnight or over the weekend. A surprise earnings report, a new medical discovery, a political event.
So how does this fit our theme of being right but still losing?
Well, let's say you've done your research.
Yeah.
You think a stock at $100 is going to go up. You plan to buy it tomorrow morning.
Okay.
But overnight, the company announces a huge game-changing partnership. The news is amazing. You were totally right.
Great.
But when the market opens, the price doesn't open at 100. All that excitement means it gaps up and opens at, say, $108.
Whoa. So the big move happened before I could even get in.
Exactly. You were right. But the gap stole most of your potential profit. The opportunity just vanished while the market was closed.
And I assume it can work the other way, too, if you're betting on a price to fall.
It can be even worse. Imagine you're betting against a stock, and you have a stop-loss order to protect you at $105. That's your safety net.
Right. If it hits 105, you're automatically out.
But if that same good news hits overnight and the stock gaps up to 110, your stop loss doesn't execute at 105. There's no chance. It executes at the first available price, which is 110.
So you lost an extra $5 per share more than you had planned.
Instantly. And there was nothing you could do about it. It's an uncontrollable risk of holding a position when the market isn't open.
So now let's talk about the overall environment, the room where the trading happens. We touched on this earlier, but let's look closer at liquidity.
Yes. Liquidity is such a core concept. In the simplest terms, it's just about how easy it is to buy or sell something quickly without messing up the price.
So how much of it is for sale and how many people want to buy it?
Pretty much. Let's use an example outside of stocks. Imagine you need $10,000 by tomorrow for an emergency.
Okay.
You have two things of value. You have $10,000 worth of a very popular, widely held government bond. And you have a rare book collection that was just appraised for $10,000.
I feel like the bond is going to be easier to sell.
Infinitely easier. It's highly liquid. There's a massive market for it. You can sell it in seconds and get very, very close to $10,000 cash.
And the rare books?
They are very illiquid. There are only a handful of potential buyers in the world. To get that cash by tomorrow, you might have to call them up and say, look, I'll sell you the whole collection for $8,000 if you could pay me right now.
So I'd lose $2,000, not because the books aren't valuable, but because I needed to sell them fast and there wasn't a ready market.
That is the risk of illiquidity, perfectly stated. And it's the same in financial markets. Big, famous stocks are like those government bonds. Very liquid.
You can buy or sell millions of shares and the price barely budges.
Right. Spreads are tight, costs are low. But small, obscure stocks are like that rare book collection. There isn't much volume. Not many people are trading them.
Which means the spreads are really wide, like we talked about.
Wide spreads. And if you try to sell even a small amount, you yourself can push the price down because there aren't enough buyers to absorb your order easily.
So being right about the long-term value of a small, illiquid company doesn't help if you need to get out, and the market structure forces you to take a big discount.
Exactly. It's a huge structural risk.
And finally, there's the one we all depend on and maybe take for granted, the technology itself.
The last link in the chain. Everything we've discussed. It all happens through technology. Your computer, your internet, your broker's app, their servers, the exchanges.
It's a long chain.
And if any link in that chain breaks, especially at a critical moment, you're stuck.
We've all had it happen. An app freezes. Your Wi-Fi drops for 10 seconds.
But in trading, 10 seconds can be an eternity. That could be the exact moment you needed to click a button to take a profit or cut a loss. By the time the app unfreezes, the opportunity is gone.
Or the price has moved so far against you that the loss is much bigger.
It's a single point of failure. And while brokers have backups, major outages do happen. And they tend to happen during times of market stress, which is when you need the technology to work the most.
It's a real irony. The tech gives us speed and access, but it also creates this dependency that becomes its own form of risk.
It does. It's a risk of the modern market.
Okay, let's bring this all together. The big idea here is that risk isn't just about being right or wrong. The market is a system with built-in friction.
Hmm. We've seen those unavoidable costs, right? The fees, the spread that makes you start every trade in a small hole.
And we looked at the friction of just getting things done, slippage from the sheer speed of the market, and gap risk, which happens when the market isn't even open.
And none of these things mean you did a bad job analyzing the trade. They're just the cost of doing business. They're
Right.
part of the structure.
So for anyone listening, especially if you're new to this, it's not enough to just ask, will the price go up?
You also have to ask, after I pay all the commissions and overcome the spread and account for potential slippage, will there be any profit left?
It's about seeing the whole picture.
Preparation really is everything. You can't get rid of these risks entirely, but you can manage them. You can choose to trade liquid assets with tight spreads. You can use limit orders to control your price. You can be aware of them.
Yeah, being aware instead of being surprised seems to be the key takeaway. Brokers are required to disclose these costs and risks, but it's up to each of us to actually read that information and understand it.
Because those costs are guaranteed. Your profit is not. The system is just built to reward those who understand where all the little friction points are.
If you're a beginner and want to understand trading more clearly, you can take our free beginner trading quizzes at trendlinegala.com and practice spotting these risks before they surprise you.
Next time, we'll talk about how to spot and avoid trading scams before they cost you money.
Thanks for joining us at Trendline Gala.